So welcome back to another session. In this session, we are going to look at Finance Act of 2025. This means that it's already a law in practice. And we look at some of the changes that took place when it related to income tax, that is income tax amendments. And these were introduced by Finance Act 2025. One, there is a repeal on digital asset tax that was applicable on transfer or exchange of digital assets, meaning that repeal means it has been revoked. Therefore, in this case, those who are transferring digital asset tax, cryptocurrency, and other assets, then the digital asset tax is no longer applicable. The Cabinet Secretary of National Treasury to issue significant economic present tax regulation within 6 months after commencement. This significant economic present tax is coming to replace the digital tax. Those who used to file digital tax, they are finding themselves that portion which was digital tax is now significant economic present tax. There is a withdrawal, or when there is withdrawal of pewters are these people who do gambling from their betting or gaming wallet, then this one will attract withholding tax at 5% for both residents and non-residents. In this, therefore, means that whenever you are going to get your money from gambling, then 5% has to be submitted by the website or the holder or whoever is conducting such exercise to the government in form of tax. Withholding tax comes in that there's a portion of your taxes that is paid in advance, then you will come and pay the rest later. That means that portion has just been withheld on your behalf. Now, withholding on sale of scrap repeal, meaning that it is no longer applicable. You cannot hold withholding taxes on scrap. Payment made by the national carrier to a non-resident for specialized technical maintenance, compliance training, or digital system support system, where such services are not available in Kenya, or services provided certified or accredited by an international regulatory standard setting or licensed body are exempted from withholding taxes. Therefore, we are seeing that the national carrier, in this case, we are talking of the Kenya Airways. You see, we are saying payments made by the national carrier to a non-resident, this one, they are exempted from withholding taxes, as long as those services or whoever is offering those services are not available in Kenya. Now, timelines for commissioner to issue decision on application for change of year end reduced from 6 months to 3 months. This means that when you make application, you want to change your year end period for your company and the rest, it should be within 3 months. The application for change of year end will be deemed approved if the commissioner fails to comply with the timelines. If you make application after 3 months, there is no reply, it means that you can move on and use that as your end or year end period. Therefore, if the commissioner does not respond within 3 months, then that stands approved. Purchase or acquisition of the feasible right to use spectrum license for telecommunication operators will qualify for investment allowance at 10% on an equal installment basis. When you are in the telecommunication industry, you shall qualify for investment allowance at 10%. Investment allowance comes in is you are repossessing the cost of acquiring your asset. Meaning, if you bought an asset at 10 million, you shall get back the cost of this asset in form of expenses. That is what investment allowance is all about. At 10% on equal installment. Meaning, you shall take 10% of that cost as an expense or capital allowance as you move on with your business. This one is to encourage more investors so that you find that when the cost is so high, then it reduces your taxable profit. Income tax proposals, here we're saying that the tax-free limits per diem increased from 2,000 to 10,000 expended per day per employee, meaning if you're earning between less than 10,000, then those part is you are not taxed. That is the per diem that used to have a limit of 2,000 has been increased to 10,000, meaning that employee now should be taxed above 10,000. Taxpayer may enter into advanced pricing agreements with the commissioner for transfer pricing purposes, which will be valid for a period of 5 years. Further, the CS National Treasury is required to issue regulations for better implementation of advanced pricing agreements within 6 months from commencement of this provision. Another thing that is coming in is there is harmonized definition of related persons to a single definition that includes all instances of relationship arising from participation, either directly or indirectly, in the management, control, or capital of the business of the other person. The definition also covers instances of relationship that is derived from association through marriage and the rest. So when you're talking about related parties or related person, they are those persons who have interest in your company. They should be disclosed so that you can be able to know if a director is a director in 2 or more companies and they're doing business together, then you should be able to know such are related parties in transactions. Expansion of the scope of significant economic present tax to cover the income of non-resident person. I said that significant economic present tax is coming in to replace the digital tax. And then we are, in this case, they're saying that it covers the income of non-resident person accrued in or derived from Kenya through a business carried out over the internet or an electronic network, including through a digital marketplace. Additionally, the exemption from significant economic present tax for non-resident person with an annual turnover of less than Kenya shillings 5 million was repealed, meaning that non-residents will pay digital tax or significant economic tax regardless of their turnover. Meaning, I think that is clear. The digital tax, if you are carrying your business around the internet within the Kenya airspace, then you are entitled, even non-resident, regardless of the amount of your turnover. Turnover are the sales or income or revenues within a year, then or within the same period that you have been taxed. Therefore, we are saying that you will be paying a significant economic present tax. There is clarity on the due date for minimum top-up tax for multinational enterprises operating in Kenya that are part of the group whose consolidated turnover in euros is 750 million or more and have combined effective tax rate for less than 15% in a year of income. The due date will be the end of the 4th month after the end of the year of income. Something also interesting here is that applicability of diminution allowance at the rate of 100% on costs incurred on any implements, utensils, or similar articles, excluding machinery or plant employed in production or gains or of gains or profits. This diminution is now similar to capital allowance, but now it applies to different class of assets. So here you are saying that you are going to get 100% on cost. You incur, if you buy, you spend 500,000 to acquire utensils that are used for your business, then in this case, you are going to account as 100% of that as capital allowance, which now we are calling this one diminution allowance. The carry forward of tax losses will be limited to a maximum of 5 years. However, this period may be extended if the taxpayer applies for an extension and provide evidence of their inability to offset the losses within the 5 years, subject to approval by the CS National Treasury. upon recommendation by the commissioner. So what this part means that previously we used to carry losses. If you made losses this year, you can offset with the profit for next year. If you don't make profit next year, you can wait until the time you make profit. Therefore, you find with the accumulated losses, you end up, when you make profits, you find yourself in a loss position, or you are not in a tax payable position. So this law says now that you can only carry your losses to a maximum of 5 years. It's no longer an indefinite period as it used to be. Now, 5 years, if your losses have not been recovered for 5 years, you forfeit them. You cannot keep on accruing losses to infinity. Now, mortgage interest on amount borrowed for construction of residential premises to be deductible expense for income tax purposes. Remember, this one was not there before. Or mortgage interest, you only paid mortgage interest when it comes to commercial premises. But in this case, you are told even when you have mortgage on residential premises to be deductible expense for income tax purposes. So when you get a mortgage and you're building your own house to live, then the interest you pay in mortgage will reduce your taxable income. Now, all gains and profit from employment income of non-citizen operating in Kenya will be fully taxable, irrespective of the number of days the individual was present in Kenya. So in this part, it means that there before we used to, for non-residents or non-citizen, we used to compute a third of their income is exempted from taxation. But in this case, we are saying all gains and profit from employment income of any non-resident, this one will be subject to taxes, irrespective of the days this non-citizen was present in Kenya. Expenditure incurred in the construction of sports facility on public grounds shall be an allowable deduction for income tax purposes. Now, this one is to encourage locals and investors to build more sport facilities to the public. And when you incur such expenditure, you are saying they are allowable deductions. So companies that will participate in construction of sport facility to encourage public or to offer, we call it this is social responsibility. Yeah? When you are getting involved with social responsibility within a community, then any construction for a sporting facility then will be an allowable deductions. A resident person that engages an unresident ship owner is obligated to deduct withholding income tax at the rate of 2.5% of the gross amount payable. That one is direct. Timelines for issuance of income tax exemption certificate extended from 60 days to 90 days. So when you apply for income tax exemption certificate, it has been, you can wait longer. You don't have to, it is no longer 60 days, but you can, if you get it earlier, still okay. But after 90 days, you should have been issued or get communications in regards to your exemption certificate. Clarification on income tax exemption on transfer of property in a special economic zone where exemption shall only be applicable to licensed developer, enterprise, or operator. That is clear. I hope, I don't know whether there is a question so far, or I can move on. Good. We move on with this. We are saying that tax incentives for companies certified by Nairobi International Financial Center Authority. The tax incentive are as follows. Now, there is an establishment of Nairobi International Financial Center Authority just to motivate investors within the country. And they are told that there will be tax incentives. There is tax exemption on dividends paid by a company certified. So dividends from such companies which are certified by Nairobi Financial Center Authority. Nairobi International Financial Center Authority. This, if you gain, you have dividends from this, they are exempted from taxes. 15% of income tax rate for the first 10 years and 20% for the subsequent 10 years. These are the tax rates applicable to companies that are listed with Nairobi International Financial Center Authority. Then the company, these are some of the key requirements for companies when they are listed by Nairobi. We are saying that the company invests at least 3 billion in Kenya in the first 3 years of operation. And those are the other a company is holding company, at least 75% of its employees in senior management are Kenyan citizens. Regional headquarters of the company is in Kenya. At least 60% of the employees in senior management are Kenyan citizens. So when you meet these qualifications and you are listed by Nairobi International Financial Center Authority, therefore, the first 10 years, your tax rate will be 15%, and thereafter, another 10 years, the tax rate will be 20%, and your dividends will be exempted from taxes. Now, some of the proposals that were dropped, we are saying that proposed expanded definition of royalty to include transactions related to distribution of software was dropped. Proposed repeal, these are proposals that were in the finance bill before it became a law, before it became a finance act. Proposed repeal of 100% or 150% event deduction in capital expenditure was dropped. You see here, we are saying that the second schedule of the income tax provides for an investment deduction at 100%, where accumulative investment value in preceding 3 years outside Nairobi City and Mombasa City is at least 2 billion, provided that where the cumulative value of investment for preceding 3 years of income was the 2 billion on or before 25th April 2020, and the applicable rate of investment deductions was 150%. The rate shall continue to apply for the investment made on or before 25 April 2025. Here we are saying those investors who are going outside Nairobi City and Mombasa City, then you get investment allowance. It's like you get back the cost of the investment as now to a rate of 150%. Yeah, you invest outside, but there are conditions as to how you can acquire this. There are limits. You are being told that there is at least 2 billion investment, and this 2 billion, the accumulated investment value in the preceding 3 years outside Nairobi City and Mombasa City. Then investment value outside Nairobi City and Mombasa City in that year of income is at least 250 million. These are some of the conditions. That particular year you want to claim this investment allowance, then at least 250 million you have invested in Kenya and it's outside Mombasa and Nairobi City. This is just to encourage development or industrialization outside the major city. Then the Finance Bill 2025 had proposed to repeal the above 100% and 150% investment allowance, and therefore harmonize investment allowance rate across industries and various sectors. It is expected that the 150 aggregated investment deduction will be phased out with time. So now, proposed repeal of preferential income rate at 15%. There's something here. Let me see what it is. Yeah. There is proposed repeal of preferential income rate of 15% for the first 5 years for companies engaged in local assembly of motor vehicles was dropped. Proposed repeal of preferential income rates at 15% on 15% on real estate companies involved in construction of 100 residential units annually was dropped. Something disturbing me here. Let me just take it down. Now, we move on. What are the changes that took place within the value-added tax? Now, one thing here to note is that the taxpayer can apply for VAT refund for excess of input VAT if they were in respect of taxable supplies that became zero-rated on 1st July 2023, provided that the taxpayer applied to the commissioner for refunds within 6 months from the date of commencement of this. Now, you see, zero-rated supplies, you can claim input VAT, but output VAT is at 0%. Therefore, you're told you can still ask for refund, even though you see the VAT Act in this way, that if the sales are at 16% and the purchases are at 16%, the difference in VAT can either be refundable or payable. When the sales are more than purchases, of course, you'll end up with the payable position. But in this case, now when the sales are at 0%, it means your input VAT are at 16%. You'll always be in a refundable position. Therefore, you are told you can still apply for refund, even if your sales are zero-rated. Reclassifications of the VAT status on the following goods and services from the general rate 16% to VAT exempt. So these are some of the items that now are VAT exempted. There is zero-rated and exemption. Zero-rated, they are at 0%, meaning you can claim input VAT and output VAT will be at 0%. Exempted, you cannot claim both. You cannot claim input and you cannot claim output VAT. So these are some of the items, when you are trading on this one, they are exempted from VAT obligations. VAT exemption status on capital goods for the manufacturing sector with investment of at least 2 billion that was granted before 27 December 2024 will be valid for a period of 12 months until 27 December 2025. There is reclassification of VAT status from VAT exempt to taxable at the general rate of 16% for taxable goods of Chapter 5, 5407. So this is, we have seen some items which were zero-rated, and now they are exempted. And here we have items now which were exempted and now they are at 16%. Now, there are some few proposals which were in Finance Bill 2025 enacted by Finance Act 2025. The definition of a tax invoice has been expanded, meaning that if you are getting a tax invoice, these items should appear for that tax invoice to be valid. There should be the word tax invoice, name, address, and PIN of both the supplier and purchaser, serial number of the tax invoice, date and time of the tax invoice issued, date, time the supplier was made if different from the dates the tax invoice was issued, description of the supplies in terms of quantity of goods. So this listed down here, they should appear in a tax invoice for that to be valid. Otherwise, you can there are businesses which don't necessarily incorporate all this when they are issuing their tax invoice. Therefore, you have been warned that these are the features of a tax invoice. There is clarity on the timeline for making VAT refund applicable within 12 months. Now you can make your VAT refund within 12 months. VAT refund application on bad debts reduced from 3 years to 2 years. Mandatory requirement for issue of tax invoice by VAT registered person on all supplies, whether VAT exempt or taxable. If you are registered for VAT, you should issue all supplies, whether exempted or taxable, a VAT invoice. And we have already discussed how an invoice features of a good invoice should be. Imposition of VAT on the misuse of exempt or zero-rated supplies. VAT to be applicable on fuels, lubricant, tires supplied to official aid-funded projects. Taxable goods excluding motor vehicles imported or purchased locally for direct and exclusive use in geothermal, oil or mining prospecting or exploration are now taxable at the general rate of 16%. Disk, tape, solid state, and all these are some of the items now which are VAT exempted. I think I was here. Let me see. Now let's look at the VAT proposal in Finance Bill 2055 that were dropped. Proposal to have VAT withholding credits only utilized to offset VAT liabilities. Now, there was a proposal that only VAT withholding credits, if you have withholding credits, can only be used to offset with VAT liability. Now, it is clear you can use withholding credits to offset other tax liability. VAT exempt supplies that were proposed to be taxable at the general rate of 16%, all this one, they were dropped. Zero-rated supplies that were proposed to be VAT exempt, this one were repealed or revoked. Let's look at tax procedure amendment. You see, tax procedure amendments basically go in line with KRA operations. Yeah? Now, we're saying tax procedure amendment in Finance Act 2025 that is not in Finance Bill 2025. Definition of certificate of origin introduced to mean an official document issued by a competent authority in the exporting country, confirming that the goods were manufactured in the exporting country. A certificate on origin is considered valid if it includes the following. That means when you are exporting, you require a certificate of origin. And it should meet the following: exporter's name, importer's name, port of origin, accurate description of the goods, quantity of the goods, country of origin, and we also have country of destination. So these are some of the things that are new that are being introduced here. That when you're exporting, you require to indicate or you require a certificate of origin. Import documentation will be processed and goods will not be cleared by entry into Kenya unless a certificate of origin and supporting documents are provided to the commissioner or authorized officer. When you're importing your goods without a certificate of origin, you risk not being allowed to bring your goods into the country. Now, procedures proposed in Finance Bill that were enacted: payment subject to withholding that is final tax are exempted from electronic tax invoice. When you're doing a payment that are final tax, is like salaries. So you don't, when you pay payee, you don't pay payee again. Therefore, those payments are exempted from withholding taxes. Commissioner is required to provide a reason for amended assessment. When you have when you have returns or your financial records with KRA are in doubt, they can easily issue an assessment. Now, you've been told that whenever KRA issue an assessment, then they should give you the reason for that assessment. Reliefs from penalties for failure to deduct withholding tax, where the recipient of the payment has already paid and accounted for in full principal tax. So when you have already accounted for your withholding tax, there should be no penalties for failure to withhold, to deduct. As long as you have paid your tax in full, then there is no penalty for failing to withhold to withhold taxes. Exempt the commissioner from payment of stamp duty on attaching property as security for unpaid taxes. That means commissioner may not necessarily something disturbing me here. Now let's move on. They're saying that Relief from penalties for failure to deduct withholding taxes to a recipient of the payment has already paid or accounted the principal tax in full. The commissioner is empowered to collect tax from non-resident through agency. Deletion of 10% VAT withholding penalty. KRA refund process extended from 90 days to 120 days, and the audit from 120 days to 180 days. So when you're asking for a refund, you can wait for as long as within that should be 4 months. Yeah, 4 months you should have gotten clearance or gotten your money back. Where the commissioner allows a late objection, the decision period starts from the date the objection is launched. The commissioner is empowered to waive penalties and interest on errors generated by electronic tax invoice. Lastly, we look at tax procedure proposal in Finance Bill 2055 that were dropped. The Finance Bill had proposal to empower commissioner to access trade secrets and customer data. This was one of the contentious issues that came into the public, that the KRA can get into your M-Pesa account, can get into a bank account and check your transaction without your consent. So in this case, that has been dropped. Proposal to exclude Saturdays, Sundays, and public holiday when computing timeframes for lodging tax objection or appeal to the Tax Appeal Tribunal, High Court, or Court of Appeal. So when you are counting days, you include Saturdays, Sundays, and public holidays. Yeah, that is it. There was a proposal to exclude this when you are told your decision should be done within 90 days. It means 90 days from the date you launch. Yeah, so including weekends and public holidays. Otherwise, those are the changes that have taken place in regard to income tax and VAT and tax procedures in the year 2025. I don't know whether there is a question we can respond to. Any question? Is there a question? Now, if there is no question, we can stop there. Can stop there and proceed